right? We are told to make the financial statements for Mukuba Supplies. In our last episode, the last video, we did our adjustments up to part 4. So today we're going to now continue the remaining adjustments. Right. So the fifth adjustment is telling us that a delivery vehicle costing 18,000 with accumulated depreciation of 14,400 was sold for 5,200 cash on 20th March 2025. No entries have been recorded. So here what happened, we sold one of our delivery vans. So first thing, we need to find out how much profit or did we make a loss when we sold this van. So in order to determine if you made a profit or a loss in the disposal of the assets, the first thing you need to do is we need to get our carrying value or our net book value of the asset. What is the value of the asset? Basically this year. So to get the carrying value, it's the cost of the asset minus the accumulated depreciation. So the van we sold, it was worth 18,000. The accumulated depreciation is 14,400. So 18,000 minus 14,400, 3,600. So this is the value of our asset. Okay. Now this delivery van, which is worth 3,600, was sold for 5,200. All right. So to get your gain or loss on disposal, it is cash minus the net book value. Okay. So we were paid 5,200 for a van that costs 3,600. So the gain we made on the disposal of this asset is 1,600. Okay. So this gain, we're going to add it to our profit in the income statement. Okay. Yes. Then, since we were paid cash 5,200, so our cash balance needs to increase by 5,200. So let's see, let me just make sure what was the cash balance. 15,740. So we're going to say 15,740 plus 5,200, we get 20,940. So in our balance sheet, on the cash balance, we're going to put 20,940. Okay, so these are the journal entries which are attached to asset disposal. They are not needed to be put when you're answering a question, but this is just for your general knowledge. All right. So since we sold the delivery van, we need to adjust our delivery van account. Okay, because according to our information here, delivery vans at cost worth 68,000. So now we sold the delivery van, so we need to remove it out of this account. All right. So yes, could you mute your mic, madam? Do you have a question? Do you have a question? Okay, so yes, the Journal entry, we debit asset disposal, the asset disposal account, and we credit the delivery vans. Alright, we're removing the delivery van from the books. This was shown by Madam. Colleagues, we are going to listen to what's happening in the background. We will hear things that we're not supposed to hear. Okay? Yes. So this credit entry is this subtraction we've done here. All right. Then also we need to remove out the accumulated depreciation for the van that we sold. Okay. So you need to debit the accumulated depreciation of, let's see, they told us the accumulated depreciation of the van was 14,400. So this 14,400 we need to remove it from here, provision for depreciation delivery vehicles, 40,800. Okay, because when you sell the asset, also the accumulated depreciation with the asset needs to go. Okay, so we need to debit accumulated depreciation. It was 14,400. Okay, well, is by debiting accumulated depreciation, it means we're removing it from our books, and then we credit asset disposal 14,400. So this debit entry here is being represented by this tabulation here. Okay, we're removing the accumulated depreciation from the vehicle that we sold. We're removing it from our books. So 40,800 minus 14,400, the accumulated depreciation for the vans is 26,400. Okay, so it's very important whenever in a question you see there's a disposal of an asset, make sure you adjust the asset account and the accumulated depreciation account. Yes, so we go to the next. They tell us a full year's depreciation charge is charged on all non-current assets owned at the end of the year. Okay, for premises, 2% straight line method. The straight line method of depreciation, it just means the depreciation expense is the same every year. Okay, delivery vehicles, 20% reducing balance. The reducing balance just means the depreciation charge reduces as time goes by. Remember, depreciation, loss in the value of an asset due to wear and tear. Then office equipment, 25% straight line. Okay, so with the straight line method, all right, how you calculate depreciation, it is the cost multiplied by the rate. Okay, so for premises, according to our information here, premises at cost 120,000. The rate of depreciation 2%. So we are going to say 2% of 120,000. That is 2,400 kwacha. That is the depreciation expense for premises that year, this year. So, for your general knowledge, okay, whenever you calculate the depreciation charge or the depreciation expense for the year, this is the general entry. You debit the depreciation expense 2,400, which will appear on the income statement. Then you credit accumulated depreciation 2,400. Okay, So this credit entry here is being represented by this addition we're doing here. Okay, so the accumulated depreciation for this year is going to be the original amount 12,000 plus the depreciation expense for the year 2,400. So 12,000 plus 2,400, we get 14,400. So this is the accumulated depreciation you're going to see in the balance sheet. Okay, yes, this 12,000, it was in our information here, provision for depreciation premises 12,000. Then we've calculated the depreciation expense for that year 2,400. So we're adding the 2,400 to this 12,000. We go to delivery vehicles, where we're using the straight line, the reducing balance method. Okay, so for the reducing balance method, it's your net book value times your rate. Remember, net book value, it is the cost minus the accumulated depreciation multiplied by the rate. Okay, so but when you're doing your in the exam and everything, just start from here. Just write cost minus accumulated depreciation multiplied by the rate. Okay, just know that when you subtract the cost minus accumulated depreciation, that gives you net book value. So delivery vehicles, their cost is 50,000. Remember, originally it was 68,000. We got rid of that van which was worth 18,000. So the remaining amount is 50,000. Okay. Then the accumulated depreciation for motor vehicles. Remember, after we did this adjustment here, where is that? Here, accumulated depreciation. When we removed the 14,600 for the motor vehicle we sold, we remained with 26,400. Okay, so this 50,000 which we had adjusted, and this 26,400 also which we adjusted, we're going to use it now when we're calculating the depreciation for the delivery vehicles. Okay, so 50,000 minus 26,400, 26,300 minus 20%, multiplied by 20%, that is 4,720. So again, you don't need to put this journal entry here, but this tabulation here is going to be there in your balance sheet. Debit depreciation expense 4,720. So you see that 4,720 in the income statement. Credit accumulated depreciation 4,720. So originally the accumulated depreciation for the vans, delivery vehicles, was 26,400. Plus this new depreciation expense of 4,720, we get 31,120. Okay, so this is the amount you should put in the balance sheet. Then finally, office equipment depreciation, again straight line method, cost multiplied by the rate. The value of the office equipment 36,000, depreciation rate 25%. 25% of 36,000, 9,000 kwacha. This is the depreciation expense for that year. Okay, so in the income statement, you're going to find this 9,000. This is depreciation expense. Then the accumulated depreciation, remember originally for office equipment it was 18,000 from the information in the question. We're adding this 9,000 which we just calculated. 18 plus 9,000, That is 27,000 kwacha. That is for the depreciation. Then the next, we've got trade receivables of 600 kwacha are now irrecoverable and are to be written off. So here what it's telling us is that we are certain that we're not going to get this 600 kwacha, because probably the person who was owing us, maybe the business closed, maybe they got ill, they can't work anymore, maybe they passed on, worst case scenario. So we are sure we're not getting this 600. So what we're supposed to do is we need to reduce our trade receivables amount. Okay, according to our information here, we've been told trade receivables is 18,900. That is how much is being owed to us. Okay, but now we've discovered that 600 kwacha is we're not going to get, so we need to deduct. Okay, so we're going to say trade receivables, okay, 18,900 kwacha minus 600, you get 18,300. Okay, this is the new amount that is being owed to us by people. Okay, then this 600 is now irrecoverable. Okay, it's now irrecoverable. Okay, so we're going to add it to the original irrecoverable debts of 1,050. If we go to the information in our question, they told us irrecoverable debts 1,050 kwacha. Now we've included the 600, so we need to add it. Okay, we need to add it. So 1,050 plus 600, the recoverable debts 1,650 kwacha. Right. So even this one, the journal entry could have been put like this: you debit irrecoverable debts 600, it's an expense. Okay, then you credit trade receivables. You are reducing the amount for the trade receivables. So this credit entry is the one that is being represented by this subtraction here. This debit entry is being represented by this addition here. Okay. The allowance for irrecoverable debts is to be maintained at 5% of trade receivables. So allowance for recoverable debts, this is an estimation of the money we might not get from the people who are owing us. Okay, as a business, if you do credit transactions, credit sales, okay, sometimes you might not get your money back, so you have to just make an estimation. Okay, so whenever you're dealing with the allowance for recoverable debts, first thing, check if there is an existing amount. Okay, as we can see here, we have an existing amount here, 500 kwacha. Okay, so at the beginning of the year, we expected not to receive 500 kwacha from the people who are owing us. Now I want to find out at the end of the year, how much are we not expecting from the people who are owing us? Okay, how much are we estimating that we might not get? So we calculate. Okay, allowance for irrecoverable debts, 5% of the trade receivables amount. So 5% of 18,300, 915 kwacha. So at the end of the year, we estimated that we might not get 915 kwacha. Okay. At the beginning of the year, we estimated we might not get 500 kwacha. Now at the end of the year, we're estimating we might not get 915 kwacha. So we can see here there is an increase of how much we're estimating that we might not get. Okay? So we have to find out this increment, it's by how much? So you say 915 minus 500, 415 kwacha. So we have a 415 kwacha increase in the amount which we're estimating we might not get from the people who are owing us. Okay, so this increase will be treated like an expense in our income statement. Okay, because the money which we're expecting not to come has increased. So in the income statement, it will be treated as an expense. If there was a reduction, then it will be treated like a form of income. Okay, yes. And the final one, insurance includes a payment of 900 kwacha on 1st January 2025 for 12 months. Now remember, for this question, our year ends in 30th April 2025. Okay, so this 900 kwacha is for 12 months. So the first thing we need to do is we need to calculate what is our monthly charge, because we know that this payment we've made is crossing over when our year ends. Okay, it's crossing over basically into our next financial year. So we need to find out, okay, how much has been used up and how much is a prepayment. Okay, how much of the insurance has been used up for this year and how much insurance is a prepayment. Okay, so the monthly charge, 900 divided by 12 months, 75 kwacha per month. From 1st January 2025 to 30th April 2025, it is 4 months. January 1, February 2, March 3, April 4. So 4 months multiplied by 75 kwacha, 300 kwacha of this insurance has been used up for this year. Okay. Then we have to find out now how much is going into the next year. How much is the prepayment? So if we know 300 has been used up this year and we paid a total of 900 kwacha, so 900 minus 300 kwacha, 600 kwacha is a prepayment. Okay, and remember, you want to do the journal and double entry for this. Remember, you debit the prepaid expense, because the prepaid expense is a current asset. So you debit 600 kwacha. So this debit entry is telling you that in the balance sheet you recognize this as a current asset. Then you credit insurance expense. Okay, remember, according to the matching principle in accounts, you record revenue and expenditure for the same period. So this 600 kwacha, it's regarding the next year. So we need to remove it out of the insurance expense, because we're only interested in the insurance expense for this year. Okay, only interested in the insurance expense for this year. So we're going to credit. So this credit entry, meaning we're going to deduct from the insurance expense in our books. Okay, according to our information here, insurance expense, where is that? Insurance 2,700. So we need to remove the prepayment which is in here, because we're only interested in the expenses for this year. So 2,700 minus 600, you get 2,100 kwacha. Alright. Yes. So those are the adjustments that you need to do for